Today on the podcast, we're very fortunate to have Matt Fitzgibbon, who is a number of things. Well, we'll say two in particular. He's my chief. He's my broker of record for Fitzgibbon Alexander, the brokerage, and he is a very, very, very experienced business broker. But also he is many, many, many years in the private equity group. And what we're going to talk about today is private equity and how private equity, in many ways, in some ways, may come along to look at the purchase of the business that we may have listed for sale and what the differences are, so that anybody who's selling a business, a little bit of preparation for the difference between an individual buyer and private equity buyer. So, Matt, well, first of all, let me say that I've been part of Fitzgibbon Alexander for a little over 5 years now.
It's been that long.
It has been that long, and it's been nothing but fun. I've known Matt and his partner, Ed Alexander, for many, many, many years since I first started in business brokering 20 years or so years ago. I knew them, and I decided to make a move from my previous brokerage. Very good people, but I decided to make a move, and I was so fortunate to be asked to if I would consider joining Matt and Ed, and it's been great since. It's been absolutely fantastic. I won Employee of the Year every year, I think, being the
yes, you have. You are the esteemed recipient of Employee of the Year. Yes,
yeah, that's right.
Agent of the Year.
Agent of the Year. That's what I am. Yeah. So that's enough from me. Matt, tell us a little bit about yourself and your business experience.
But on that note, it has been fantastic to work with you, not only over the last 5 years specifically, but in the last 20 years that we have shared war stories of our experiences transacting businesses. Between the three of us, we've had a lot of war stories, and it's been our blessing and pleasure to have you work with us. So we are grateful.
That's great. Thank you.
Background-wise, of course, certainly Fitzgibbon Alexander is a business brokerage and valuation firm. The not so known side though is I've been managing a private equity group and making private equity investments since 1994. And that has pretty much been the majority of how my time has been spent in the private equity world, with private equity groups in a multitude of spaces, from manufacturing companies, distribution companies, all the way to every aspect of real estate, hospitality, lodging, et cetera, et cetera. So oil and natural gas, energy, alternatives, we've pretty much had a hand in every space, which has been a good education over these years, because obviously everything had a learning curve. And some things have been, as always, some things have been incredibly successful beyond our imagination. And we've also have the nuclear failures to also talk about too. So it depends on where you want to go with that.
Come out a better person at the other.
Yes, you do.
At the other side.
It's all character building.
I just want to talk about the qualifications that you hold in the appraisal side of the business, of which I don't, and I'll talk about that in a second. First of all, let's talk about Ed. Is missing from our little happy little band at the moment. Ed, of course, is an attorney, so maybe we should just sort of introduce Ed to everybody, although he's not here.
Yes, Ed is a business law attorney and has the Alexander Business Law Group here on the east side of town, and a very well-known, well-respected business law practice here in Orlando. And we first met back in, the quick story is early 2000-ish. He was representing a seller of a restaurant downtown. The seller approached me to broker the deal. And I gave him my listing agreement, and I'd never met Ed. They gave it to Ed, and Ed sent it to me, and it was all redlined. And there was very few black letters on the page. And as a really young guy,
attorney-itis,
I was a little taken aback, and I actually called him up and just said, "I don't know how to respond to this." And he said, "Well, I've worked with a lot of brokers, and I just want it to be if you sell the business, you get paid, and if you don't, you get nothing." And I went, "I'm good with that.
That's
That's
it.
okay."
That's it.
He said, "You are?" And I said, "Yeah." I said, "Okay." So we did the transaction. It was a very difficult transaction with a very difficult buyer. And fortunately, his broker, Ed, and I all worked extremely well together. We were very impressed with each other and have kept in a relationship and as colleagues this whole time. But then Ed and I went on to refer business back and forth. And we closed the next 5 deals we referred to each other and
Aha.
went out to lunch and went, "That never happens.
Ah.
So maybe we should talk about this." And that's when he said, "Hey, how about if we partnered here on the Main Street business transactions?" And that was how we got Fitzgibbon Alexander started.
Very good. Very good. Excellent. And I've used Ed separately a number of times, even before I joined. And he's a first class guy, really, really first class guy,
Absolutely.
and a very nice man as well. So it's a happy little band we have. So I'm going to just take us back, yeah, 15 or so years ago, and when things were not so good in our industry, when we had that
Yeah.
there recession thing. And I remember you and I having a conversation, and you said to me, Sean, one thing you might want to consider, because I'm going to do this, you might want to get yourself sort of tooled up in the appraisal side of the business, so that you can do more. You can be an expert witness. You can handle divorces. You can have partner split ups. You can so that you're an expert in the field, and what you need to do is you need to be well qualified in order to do this. And I remember saying, Matt, I can tell you there ain't a chance of me doing that. So when I prepare an appraisal, it's called a broker's opinion of value. It's all good, strong stuff, and I learned a lot at the IBBA and other such places, International Business Broker Association. But I do not have the qualifications that this young man has. So just tell us, if you would, what you then went ahead and obtained so that you could
Mm.
take that role.
Well, you were smarter than I was because you skipped out on all of that. I, being a glutton for punishment, decided to pursue that credential. So I joined the American Society of Appraisers, which at the time, and I would argue still today, is the gold standard of appraisal, and especially in the business world, and when it comes to business appraisals. And I traveled around the country to 4 or 5 different classes that were 4 days long, something like that. And over the course of a couple of years, earned the Accredited Senior Appraiser in Business Valuation designation with the American Society of Appraisers,
Mhm.
which did then credential me to do expert witness testimony in litigation, business appraisals for the SEC, the IRS, or basically any governing body. And I did do that more heavily than the brokerage side for a number of those years in the slow time. And it was a great experience. I figured, though, naively, I thought that since I've been valuing businesses since 94, this is going to be easy. And I had an MBA and I've been doing brokerage for years. But I found it to be much more challenging and difficult than I anticipated.
Mm.
I was, even with everything that I had experientially and educationally, I think I was probably the dumbest guy in the class. I
Really?
mean, it was a bunch of chartered financial
Oh,
analysts and whiz kids coming out of math degrees, and it was very challenging. But I did do that for a number of years,
hmm
and I did do a lot of work for attorneys for divorce cases, partnership disputes, dissolutions, gift tax, et cetera, et cetera.
So, well, rather you than me, I have to say, and good, good,
Yeah,
good on you for doing that. But that was never something. But it is very important to understand that a broker's opinion of value is exactly that.
mhm.
And that's what we use in our industry generally, and we could talk about that in ad infinitum. But that's what we use in order to appraise a business for sale, for that business for sale. That's what we need to be able to do. That's what I learned at the IBBA over all those years ago before I became a CBI. Oh, by the way, we're both CBIs, Certified Business Intermediaries. We're both lifetime
Yes.
CBIs, which we're very proud of. So that's where we are. Just to give you the platform for where we are now. Here's the essence of the discussion that we're going to have, and I'm going to start with a little statement of mine. And Matt may not agree wholeheartedly with what I say, but when I talk to business sellers, and I only this week I had this very conversation. So who will buy my business? Well, there's two types of buyer, say I. There's your individual buyer, and that individual buyer is coming along to buy your business and step into your shoes, sit in your seat. And what interests that individual is the seller's discretionary earnings that
Yes.
he should be able to put in his or her, pocket. But there's also another type of buyer, and I classify that other type of buyer as a big boy buyer. So that's private equity groups, institutional investors, and companies that have 150 units around the country, and they want to add 4 more in Florida, say. So that kind of thing, and we've
Yes.
experienced all of those. But we'll call them pegs just for short. But that encapsulates all of that. So in this conversation, when we talk about pegs, it's that's kind of a buyer. So my first question, so can you give me your explanation of the difference between what we'll call those two types of buyer? Is it as simple as I make it, or is there something more sophisticated in that?
Well, I think it's as simple as you just laid it out, Shaun. I think though from that simplicity comes a lot of different practices in the way things are done and the expectations and things are calculated. But it all really comes down from when you're looking at an individual main street business, you have an owner seller who is working in the business to get a salary for themselves and also a return on their investment in the business. But in the private equity world, you very rarely have that. You have a group of people who have pooled money together to go buy businesses. And so they are hiring the CEO, they're hiring the management and the leadership versus actually the people with the money and who own it working in the business. And it's those two differences that drive a lot of whether we look at SDE and EBITDA and things like that. So I think that is a fundamental, foundational understanding that people need to have as to why everything else flows a little bit differently.
Okay.
Some things flow align exactly, but some things flow very differently because of those two different ownership structures.
So would I be right in saying that generally private equity groups generally put managers into the businesses that they buy, and those managers then are running the business on their behalf, and they've got tasked with, with making the numbers that they're supposed to make. So would that be a general sort of simple difference, if you will?
Yes.
Okay.
Yes.
Versus an owner going in and running it themselves. Okay, all right.
And one thing I would add,
Please.
typically that CEO and that management team is going to be tied to the performance. So they're not technically owners, or they might be given a little piece of the ownership as an incentive and motivator, but they can all be removed by the private equity group, the group of investors. So they're not making the discretionary decisions that somebody in their own business might make. For instance, a guy who's got his own business, he's the sole shareholder, he's making $200,000. Well, he could pay himself a salary of 100, but then if he wants, he could also expense his airplane and his condo on the beach and, buy a Maserati for his best sales guy because he's been with him 10 years. That's not going to happen in the private equity. The CEO does not have the discretionary ability to make those decisions or he won't be there very long.
Very long, yeah. And I know that from my time in the corporate world.
All those years in the steel industry. Yes, you know exactly how this
I can
works.
tell you that, absolutely. That's why I'm doing what I do now. When I've had enough of looking up and looking down and saying, "Oh, here we are, it's the meat in the sandwich." So generally speaking, when we make an offer for a business on behalf of an individual buyer, we do that, and particularly here in Florida, we do that with an asset sale and purchase agreement, a
Mhm.
contract, a document. But pegs tend not to do that. They tend to use LOIs, I think, don't
Yes.
they? Yeah.
And I think you could always expect an LOI from a PEG versus the Main Street wants the contract versus an LOI. But but in that, I think there's a lot of interesting things. For instance, when you've got an individual buyer, the seller wants a contract because it's real easy for an individual buyer to write up an LOI, and individual buyers are sometimes emotional. They're sometimes looking at 5 or 10 businesses at the same time. So they're not very reliable.
Mm-hmm.
That's why the seller wants to lock in the buyer with a purchase agreement that shows that the buyer has actually gone through and thought this all out.
Right.
When you're dealing with a PEG, they're putting an LOI out to you, to the seller, as a buyer, of course. The PEG comes in as a buyer. They're putting an LOI out to the seller, but they're not on a fishing expedition and they don't have time to waste.
Mm.
So if they're going to give you an LOI, it's going to be comprehensive enough for you to understand exactly what the terms are going to be.
Mm-hmm.
And if you can get to the signature on the LOI, as long as your due diligence plays out, you've got a very high probability of closing that transaction,
Right.
because they don't have time to mess around.
Right.
Unlike the guy who's looking at a bunch of businesses, and you might throw an LOI at 2 or 3 and to see which one he gets the best deal on. There's a lot of emotion and negotiating that goes into the LOI stage in the
Mm-hmm.
Main Street world, not so much in the private equity world.
So if you are a business owner, and your
Mhm.
business is for sale, and a private equity group comes in and submits an LOI,
Mhm.
they mean it.
Yes, they do.
Now, that's a biggie, that isn't it? Yeah,
Yes,
because
I
it's an
would be very
emotional. Yeah,
comfortable as a
yeah,
business owner
mm,
getting an LOI from a PEG.
right, okay. But how concrete is an LOI?
As concrete as you make the terms of the LOI.
Aha, what a good answer. That's a hell of an answer. I like that.
So regardless of
Yeah.
Main Street or private equity,
Mm.
how tight you make it
Mhm.
is going to determine a lot what your probability and risk is to
Mm.
closing the transaction down the road.
Can you get if you're a business owner, can you get clauses in an LOI that penalize the buyer, the PEG, if they don't meet the conditions as agreed? Timing,
Absolutely.
hold on. Okay, that's good. That's really important to know.
It
isn't
just has to be spelled out very clearly what's
Mhm.
binding, what's non-binding, et cetera,
Okay.
et cetera.
Okay.
That's why I do, especially at that level, you're likely going to have some legal counsel
Mhm.
in putting that LOI together or reviewing that LOI.
Right.
All
right.
depends on the sophistication of the private equity group.
Right.
Some of them even have in-house counsel,
Yep.
and
Yep.
it's not because they want to badger back and forth. They just want to make sure that everything is very clear and
Mhm.
very well understood,
Okay.
so that we have fewer problems down the road.
Right. Okay. Okay. So pegs, how do they evaluate a business? How do they price a business?
Mm.
What do they do?
Well, I think the answer is it depends. The answer that nobody likes to hear, right, Sean, that we give all the time? Well, it depends.
It depends.
But it really truly does depend on the private equity group. For instance, I'll give you several scenarios. For instance, if it's a private equity group that's doing a bunch of roll-ups in the same industry,
Mm-hmm.
they're buying HVAC companies throughout the state of Florida,
Mm-hmm.
and they've done 15 transactions and they're looking to do 15 more. They've been in the business and done enough transactions long enough that they have their own internal formula for what they will pay, either as a benchmark of revenue or a benchmark of a certain profitability measure. They will have an internal structure. And so they might even come to the seller and say, hey, if you want to sell to us, here's what we would give you based on your numbers,
Right.
because it's all internally based.
Okay. So,
Others
okay.
will obviously look at the market and we'll look at transactions.
Mm-hmm.
And then there's others like the ones, one of the primary ones I've been affiliated with for 30 plus years out of Chicago. All the transactions we do, we want to make our money before we sign the closing documents. And what I mean by that is when we look at a business for sale and we think about adding that platform to our portfolio of companies,
Mm-hmm.
we are going to look through the due diligence at not just financially, but we're going to look at the leadership. We're going to look at the finances. We're going to look at the CapEx. We're going to look at their technology. We're going to look at cost savings that we can implement, efficiencies we can bring to the table. We're going to look at all of that and how we're going to run the business post-closing.
Mm-hmm.
Then we put a pro forma together of what we are going to invest and do to this business post-closing and what we expect the business to do because of what we do as we touch the business. And if we can't project in our pro forma a greater than 20% return, we're going to pass on the transaction. So on the day that we sign a document and we close on a transaction and shake hands, we believe we've already made our 20 plus percent internal rate of return on this transaction.
Yeah.
So that drives a lot of the pricing and the value. And so people say, well, sorry not to go down a tangent here, but everybody goes, well, private equity, middle market multiples are 3 to 5 times. Well, okay, that's a standard you'll find on the internet and you'll find on online calculators, but it doesn't really mean a whole lot if the business has got a really high growth trajectory.
Okay.
Or it has a not so high growth trajectory.
Okay.
We take all of that into play in our pro formas, but it all has to come back to the point of we are going to make the metrics that we need to make for our investors, or doesn't matter what the price is. So sometimes we will pay 6, 7, 8 times, maybe more, for a business because we look at it and we say, under our leadership, with the influx of capital we're going to put into this for technology and the relationships we have in this industry, et cetera, et cetera, et cetera, we can pay a lot more for this because we know that under our leadership with what we're going to do, we can still make these numbers. So that's the way we come at it. And I'll give you one more example, and feel free to cut me off.
Well,
I
I'm
could
going
tell examples all day.
Just
but
hold that thought, just
Okay.
as they say, for a moment.
Okay.
Don't forget it, because I just want to make this point. What you've
Please.
just heard there, business owners, is absolute gold. And what you've just heard is gold from Matt, because he's just given you the insight into exactly what private equity groups are thinking and exactly how they operate. So if you hear, oh, they're sweeping up, they're coming down into Florida, sweeping up, or car showroom, car maintenance, or tire companies, tire businesses. Yeah, they do, but they do it based upon their own knowledge and based upon their own experience and all those other criteria that Matt was. So it's not done on a whim. It's done very, very
Right.
carefully and very scientifically. Right.
It's strategic.
It's strategic. Yes.
It's always strategic with a private equity group.
Yes.
And then, of course, that affects value too. Is it a strategic buy? Is it a synergistic play?
Yeah.
What are all these different characters at play?
Yes.
But one example,
Please.
For instance, efficiencies we bring to the table. This seems like a very simple example, but we bought a kitchen and bath cabinetry manufacturer, a very large one in the Midwest 20 some years ago. And the gentleman who had built up the company, and he was very successful, had expanded into California. He was building the kitchen cabinets and bathroom cabinets in the Midwest and shipping them to California and delivering them to California customers. When you do that, 80% of what you're shipping is air in the back of that
There you
18-wheeler.
go. There you go. Yeah.
So when we bought the company, we still did all of the cutting, painting, finishing, everything of the drawers and the cabinets and countertops and everything. We did it all in the Midwest in the manufacturing plant. But all we did was we went to California and we got a big warehouse facility and we employed people to put everything together in
Assembly.
California.
Mm.
So what we shipped across the country was 90% material and
Mhm.
10% air, or
There you go.
5% air
There
if
you
we
go.
could pack it in tight enough,
Mhm.
versus 80% air. That seems like a simple thing to people, I think, when I've told this story over the years. And they say, well, duh, it's a multi-million-dollar company. Why didn't the seller figure it out? Well, he knew that.
Yeah.
But he had been doing this for 30 years. He was successful. He was very profitable. And in order for him to do that change, he would have had to fly to California. He would have had to get a warehouse, hire the staff, get a manager, assume the risk and the personal guarantee of a very long-term lease, et cetera, et cetera, et cetera. And he just didn't feel like doing that. He was tired. So that's
Yeah.
where we come in as a private equity group and go, we have the time, we have the talent,
That's very
and we have the money to do these efficiencies and improvements. Pay him um, a very righteous price for his business,
Mhm.
include him in the sale,
Okay.
and then build the business multiple times larger. And I guess that's one other point I would put. If a seller is going to sell to a private equity group, I can't say this about every one of them, but the ones I have experience with and have worked with and invested with, we want to partner with the seller. If they don't want to just retire and leave,
Mm.
we would like them to stay on. And
Mhm.
in more of our transactions than less, I think it's fair to say, we've even kept the seller on as the CEO for a number of years afterwards.
Mhm. Mhm.
So then they also get an equity piece. So
Mhm.
they get what we call the second bite of the apple
Got
when
it.
we sell the business
Got it.
years later.
Mhm.
So I do think that's important for people to understand, because a lot of sellers are like, well, why does it matter if I sell to a financial buyer or a private equity group?
Mm.
Well, it depends on what you want to do after you sell your business and what level of involvement you want to have or not have. And all of that's on the table, but that's ideally how we would like to do it.
Yeah, that's very interesting. I always say, following on, that some you come across a business, you just say the owner said, "Well, I've done this, I've done this, and this, and this, and it's doing this." You say, "It's great, well done. You've taken it from A to B.
Mm-hmm.
Now,
Yes.
that's what we need is somebody who can take it from B to C, and let's take it to the next level." And you're not necessarily there. You've got all these other things to run the business, etc., etc., etc. Let's find a buyer who could take the business to the next level because they're tooled up to do that. They've got a bigger team to do that because they may have different units around. So that's very
Yes.
very telling indeed. Um, I was in Scotland earlier this year, as you probably recollect, and I may not have told you this, but I my daughter has a friend who's a very senior guy in one of the Scotch companies over there. Very very senior. He's just been promoted from CFO to CEO, and he's a smashing guy. But whenever I see him, which isn't often enough, but we happened to be up there and with him, and we were talking. We always talk Scotch, and because I love that. What makes it. The one motto is "Don't ship glass."
Mm-hmm.
Don't ship glass.
There you go.
Right at the end, that's when it needs to be in glass. So let's just what level of seller's discretionary. Oh no, no, take a step back. What's the difference between seller's discretionary earnings and EBITDA? Have you got an hour? Says
Exactly. So EBITDA, of course, your earnings before interest, tax, depreciation, and amortization. Seller's discretionary earnings has a very technical definition with the IBBA, the International Business Brokers Association, but technically we're adding back an owner's salary onto that. And there's a little bit more to it, of course, but we are with seller's discretionary earnings, we are removing all the discretionary decisions that that individual owner has made, like I referenced his airplane or his condo or his vehicle or whatever he's spending the proceeds of the business on. And we are getting rid of that noise, getting back to the profitability of that business apart from his decisions.
Mm-hmm.
I explain it to folks as my sellers is, if you were to hand me the keys to your business today and I ran it the same way next year as you ran it, how much money would I have to be able to put in my pocket, pay myself a salary, take distributions, put different expenses on? What would that number be? And that way we can compare businesses on an apples to apples basis. And we do that with EBITDA a little bit by normalizing it, but it's usually for CapEx and other things, not to get into the weeds.
Into
But
the weeds yet. Well, I'll just say the way that I've been round and round this, and I think you and I have discussed this previously. I've been round and round this whole issue between seller's discretion, EBITDA, seller's discretion. So what I do is I calculate seller's discretion and I stop. I do not, because one man's EBITDA may not be another man's EBITDA.
right.
So I say, well, the seller's earning 75,000, so I'll just take 75,000, and then we've got off seller's discretion, and we've got EBITDA. Buyer comes in, private equity group, and says, oh, that's all very well, but we pay our managers 125,000. Therefore, EBITDA is 50K less. So I've been round and round this. So now I just do seller's discretion. Say, it's up to you, sir. Whenever I was talking to a private equity guy this morning, I had this very conversation with him, and he said, I agree. That's the way to do it. So at least I've got one disciple out there. Oh, right. Okay.
Well, the good news about it, EBITDA, though, is using that is
Yes.
it does get rid of a lot of the noise.
Mm-hmm. I understand.
Because since the CEO it's not his business to make decisions on some of these discretionary things. He's working for a group of investor owners. He's not going to put his airplane and his condo and all that stuff
That's
through
right.
there.
Yep.
And if he's making an outsized salary, it's probably he's going to be replaced by somebody else in the market.
Yep.
And if they buy the business and the owner was paying somebody less, then it's probably going to be brought into somebody else at market. So a lot of the noise gets evened out
Mm-hmm.
in the private equity world automatically to a more professional, market-driven numbers and expenses, all
Right.
your ratios and consolidated numbers. But it still needs to be normalized.
Right.
You still have to take into effect, what
Yeah.
about CapEx?
Yeah.
And have they been paying that? So I use the term normalized EBITDA.
Normalized.
We have to
Okay.
look at the EBITDA,
Mm-hmm.
but then we have to normalize it. So again, if you gave me the keys to your business and I ran it the same way, is my EBITDA going to be the same next year,
Mm-hmm.
or what factors are going to be different? Were there one-time expenses or lost contracts and things like that? So
I had that CapEx discussion with a seller only this week.
Okay.
What's your CapEx? Well, there we are. But we
Yeah.
could, well, I mean, it's endless, this stuff. It really is. We could go on for a long, long time. So let's, what are they normally looking for, Pegs? What level of EBITDA what level of EBITDA? $1 million, 2 million, 3 million? What?
That is changing, going back a couple decades.
Mm-hmm.
A private equity group was looking for a minimum of 5 to 10 million or something like that.
Mm-hmm.
It has gotten so competitive that I would say 10 to 15 years ago, a lot of the private equity groups, because they couldn't find, there's more money chasing good deals than there are good deals out there.
There you go. That's interesting.
So the private equity groups started reaching down to smaller businesses.
Mm-hmm.
So they started to get wise and go, well, let's look at companies only doing $1.5 million or $1 million in EBITDA, because that might be the next, AI champion, and maybe we can find a diamond in the rough down here.
Okay.
So they started reaching lower and lower and lower. So you will find some private equity groups that might reach down below a million into a 500,000, but rarely. However, I got to also add just as quick, Shaun, that a private equity group will go after any company of any EBITDA if it helps our platform company.
Right.
So we would not add, for instance, we would not add a platform business that's making $1.5 million, $2 million, $3 million.
Okay.
But if we buy a company that's doing 10, 15, 20 million, and we find some smaller add-on acquisitions, they might be making $100,000.
Okay.
We don't really care.
Okay.
But if they have something that brings a competitive advantage to us, or a market advantage, or a new product, or intellectual property, or a new region, or a new country, or regulations, or we find an add-on for a platform, we'll reach down to any level. The
Okay.
EBITDA doesn't really matter
All right.
because we have a strategic plan for it as far as the
That
platform.
makes it. That makes a
So
lot of
I
sense.
just say,
Yeah.
it depends on whether we're talking platforms or add-ons.
Okay. All right. So yeah, this is not a simple subject. So if a business has cash in the bank, accounts receivable, and work in process, how do all those factors affect what a private equity group might do? And I just want to say, I'll just really add a little bit more to that question. My experience is that private equity groups say, okay, we're making an offer for the business, but we're not, once we've paid for it, we're not going to inject any more money into the business. That's it, and it's going to run on its way. So that means that the work in process and the accounts receivable is viewed in a different way to the normal individual buyer, because the individual buyer, then we've got to look at working capital that's needed going forward, so they address it in a different way. Just give me your thoughts on that.
Yeah, the private equity group is almost 100% of the time going to ask for working capital to be included in the sale of the business.
Yeah, that's a biggie.
And the individual business, the seller is going to walk away, take all the cash out and all the receivables, and pay all the payables as of the closing date, and leave zero in the bank. So the buyer of the Main Street business is going to have to come with additional capital to put in there for payroll that week and buying new inventory, et cetera, et cetera, et cetera. That's the way the Main Street world works. And that's primarily because there's so many discretionary decisions, again, between what's in working capital versus in the private equity world. They're run pretty efficiently. The middle market businesses that are owned by private equity companies, or private equity groups rather, are run pretty efficiently. So the working capital is expected to be there. Private equity groups plan to inject money to build the business and take it to a new level, but they buy the business expecting there to be enough working capital to keep payroll done, inventory, and everything rolling forward as it normally and customarily has been done.
Okay.
But I would also argue that also factors into the price. It doesn't mean that you're paying more for it or less for it. It's all factored into market multiples, whether you're looking at PEGs or you're looking at the Main Street businesses.
Gotcha. Yeah.
But there's a lot of discretion between the Main Street business owner who says, I'm comfortable with 2 weeks of payroll in the bank, and the individual Main Street business owner who says, well, I would never have less than 3 months of payroll in the bank in my cash account. So those things all get weeded out the way the Main Street world works.
Working capital. You ask a business owner, what would you say they required working capital's gonna be here. Well, well, I've had this business 25 years, and I started off with it in the garage, and yeah, and then I have people employed, and well, how much do you, well, I usually keep 500,000 in the bank. Oh, that's not the answer. So that's a very we could go on forever on that
Or you
particular.
say, "How much working capital does your business need?" And they just
Mhm.
look at it and go, "What?
What's that?
What do you mean working
Because
capital?"
they've never had to worry about it. Yeah.
Never thought about it,
Mm,
and that's not a harm or foul. That's
yeah.
just you don't need to do that when you have your own business.
Yeah.
But it's not like that, obviously, in the
The
private equity
property group.
world.
Well, let's talk about the army of people that Pegs have behind them. Attorneys, CPAs,
Mhm.
negotiators. What does the seller do to counter all of this? Well, I guess where the attorney's concerned, call up Ed Alexander. That's right.
There you go. He can be found at the Alexander Business Law
He
Firm
can.
over on Lake Underhill Road. Uh, well, they do have a lot of resources. There's no question about it.
Mm,
But if the business that they're pursuing is run with integrity, appropriate and proper, accurate books and records, there shouldn't be that big of a deal. There shouldn't be any issue.
mm,
Where all of these heavyweights come in is if they're trying to resolve issues and problems. But as an example, as we talked about before, several years ago, I sold a business to a private equity group, and I set up the vault room. And at the end of the due diligence period, we had uploaded over 500 documents to the vault room. And there were 16 people from the private equity group who had been given access to the vault room,
16.
which included, of course, accountants, people doing quality earnings reports, attorneys, sales folks. I mean, all through the different departments and operations, everybody had their eyes on it. It seemed logistically difficult, but because all the data, the company had integrity in their data, they went into the vault room, they could all figure out their little part, and we didn't have any issues on things like that.
Mm,
So,
mm,
as long as there's integrity in the information and integrity in the process and in good faith in how the transaction is progressing,
mm.
you shouldn't have any problems with a
Yeah,
private equity
I
group.
like that integrity in the process. I like that. That's a good. And of course, you knew when I was going there with the vault room, which we use.
Oh,
We use a
yes.
vault room for all our deals, and I don't know how I existed without one. So I use it in many ways. I use it initially when we get the business listed. I put all the information there for potential buyers, and then separately to that, if we go under contract, when we go under contract, I have another section of it, and I build that up to respond to the due diligence, which I've just been talking about earlier with a really good CPA that I
Mm.
must introduce you to. It's a beautiful way of doing things. So we're rocking along here. Would you say that the seller will incur more costs when dealing with a private equity group than with an independent buyer?
Not necessarily.
Okay.
I think because in most cases, a transaction is going to transpire that both parties will incur their costs.
Hmm.
So again, if everything is straightforward and there's integrity to all the data and numbers and everything that's been presented, uh, it should be it should be the same
Okay.
for both.
All right. Okay.
And
Good.
I would
So,
argue, I, I find it much easier to work with a private equity group than it is to work with individual buyers because there's less emotion. It's more professional. They do have, it's a little bit more cumbersome because they have higher expectations. They're not going to look at you and go, yeah, that's probably fine. They're going to ask for, that sounds great.
Mhm.
Could you send me that document that shows that?
Mm,
So you're going to, okay, let me go dig it out.
mm,
So it's a little bit more cumbersome.
mhm,
I would say maybe a little bit more time consuming because of the amount of data they're going to ask for and the amount of due diligence they're going to want to do.
mhm.
But there should be far less emotion and volatility in the process.
Well, what I a couple of years ago, I sold a business to not a private equity, but a company that had locations all around the country, and they wanted this particular location. We saw, and they were extraordinarily professional, and
Good.
they were nice people. I have had other examples, I have to say, but this particular one, the one that's most recently in my memory, was a happy one. The deal got done, a couple of little snags, but we got it through. They were great people, nice people to work with. They genuinely wanted it to happen. They were focused on the business, and it happened. So, again, we had a happy buyer and happy seller there. Which
Nice.
is something that I'm going to give you one little quick statistic, and then I think we probably have a final question. I was just to give people a sort of flavour for what goes through private equity groups and how they operate. I was at a presentation a number of years ago, a private equity group that's located over in Tampa. You probably know them. I won't say their name, but what the guy was saying, he said, in any one given year, this was then, it's a few years ago, we look at, we have 3,000 deals across our desk. We look in some detail at 300. Having done so, we then make offers on 30 and we buy 3.
Hmm.
They are this particular group, and I'm sure they're all the different. They were very, very choosy about what they do, and but they put the work in. They said, the 30. Obviously, if they put the offers in, does that sound like a correct sort of percentage of, or have you not had that experience in your?
I think that obviously it's true of them.
Mm.
I would say that those statistics might be more true of an agnostic private equity group
Okay.
who is simply out there looking for any industry, any type of business that's going to hit their return marks.
Mm-hmm.
They're going to look at 3,000. One of the ones in particular that I've been investor with for these 30 years, they are looking strategically at different industries. As the economy rolls, as time rolls, there's certain industries they want to focus on. Sometimes they would less of others. They might look at 400 deals a
Mm-hmm.
year,
Mm-hmm.
but they don't. I wouldn't say they put 30 LOIs out and
Right.
close 3 or 4.
Okay.
I would say that of the LOIs they put out, they
Mm-hmm.
close the majority of the LOIs that they put out.
Oh,
Because
really?
we also do things a little bit differently.
Mm-hmm.
Some just handle everything from a distance. This partnership group I'm thinking of in this particular case, first thing they do is get on a plane when they find out about a business and they go meet the owner.
Okay. How good is that?
They'll be
Yeah.
there the next day if they like
Mm.
the deal.
Okay. Okay.
And they will know very quickly if this is something we want to do or not.
Mm-hmm.
Some private equity groups have operational partners as well. Like of several I'm in, we have operational partners who are owners and they're involved in the operations and they have operations experience.
Mm-hmm.
Other private equity groups are strictly financial, bunch of finance guys or wealthy folks who've pulled money together.
Mm-hmm.
And then they're hiring out to management companies, management teams to manage the business and
Okay.
run the
Right.
business.
Right.
So whether you are an operational private equity group and you are operating the business, or you're a financial private equity group and you're finding others to operate the business,
Mm-hmm.
is going to determine the way they do things as well.
Right. Right.
So a lot of it is going to determine on, we call it the core discipline of the private equity group.
Mm-hmm.
And every private equity group has their core discipline that they do not want to drift away from because they've promised their investors, this is what we're doing. A good example is back in the late 90s, I joined a private equity group, a smaller one, where we raised capital and we built about a dozen Marriott and Hilton properties. Hilton Garden Inns, Courtyard Marriotts,
Really?
Homewood Suites,
Really?
and operational partners. So some of us, I was very young, believe it or not, and didn't know much about the hospitality and lodging industry. So I came as a representative of investors and investments on the advisory board. And then a couple of our advisory board members were had been in the business, the hospitality industry, for decades. And they oversaw then the operations, the hiring of GMs and the construction, et cetera, et cetera. But the point was, we had an opportunity to build, we built a Hilton Garden Inn in Virginia, in a very, very high net worth area. And there was a huge parcel that we also owned next to it. And we had an architect design an office building that they needed very badly in this area.
Mm-hmm.
And the operating partner brought it to the board and said, look at all these returns. This is a no-brainer, et cetera, et cetera, et cetera. And the advisory board, I was very young. I was kind of like, well, this looks like a good idea. Several of the very experienced older gentlemen at the table said, that's not part of our core discipline. We're not doing this.
There you go. Yeah.
To which some of us, like me, the young guy, was like, what do you mean we're not doing this? This is a no-brainer. I'll do this. Let me do this. Here, where do I invest? Where do I sign? And
Yeah.
we passed up the opportunity. He convinced, there was 2 or 3 of the guys. There's probably 8 of us on the board, 9 of us on the board. They convinced us, we're doing Hilton and Marriott hotels. That's what we told our investors we were doing.
That's the thing, isn't it?
That's what we are doing, and that's why we put our money in, and that's why the rest of you guys put your money into this. That is an office building, and that is not in our wheelhouse. We're not doing that. And we passed up on the opportunity. So again, every private equity group is different. And one last thing on that, Shaun, I think it's really important when we talk about private equity, this is just rolling in the back of my head, that we differentiate between private equity and venture capital. Because the sellers always say, when I say something, if it's a larger business and I say, well, this should be attractive to the right private equity group, they're like, I don't want to deal with that. What do you mean? Oh, I've heard about those guys. They swoop in with a lot of money and they make promises and then they're gone and you end up losing the business and they take all the money out of the business and they financially re-engineer everything. Whoa, 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 whoa. You are talking about bad experience stories with venture capital funds, not private equity funds. So it really is important, if a seller is really going down this road, that they understand the difference between a private equity fund and a venture capital fund, because those two are as different as night and day. I do nothing in the venture capital world.
Okay, that's a really good point. It is a very good point. And I think it's probably an excellent point to end on. I think we've exhausted the subject. The reason that I was keen to ask Matt to join me today is that there's a lot talked about, again, my big boy buyer thing, but it's really private. Let's call it what it is, private equity. There's a lot, people come along and, oh, well, they're going to buy a lot of this up and buy a lot of that up. And then people get scared because they're dealing with bigger entities rather than just individuals. That's how deals are done in that side. Matt's given us some incredible insight there, I think, which I'm very grateful for. Thank you very, very much. I think we'll leave it at that. I think we've probably got a little bit over the time that we anticipated. So I don't think there's really too much more to say other than, if you do encounter somebody who is talking to you about private equity acquisition, you know who you can talk to now. You can talk to Matt. You can always get to Matt through me, of course, 407-592-9388. But this is what we want. We want happy buyers. We want happy sellers. And just come and talk to us at any time. Matt, I really appreciate that fantastic insight.
It's always great to catch up with you. Always great to talk to you.
I've learned a lot today. I've learned a lot. I really have. It's been tremendous. Thank you very much.
It's great to be with you always, Shaun.
Right,
thank you.
Thank you. Cheers. See you next time. Well, that's it for this episode. Thanks for listening to Happy Buyer, Happy Seller. The sad truth is, only 15% of businesses listed for sale actually sell. Hopefully this episode removed some of the stumbling blocks to sale and highlighted the ways in which barriers can be overcome. If you're a business owner thinking about selling or a buyer considering your next step, I'm always here to chat and help you think through your options. So, to learn more, or access additional resources, then reach out to me directly at www.happybuyerhappyseller.com. Don't worry if you're not ready to make a move yet. An early conversation can make a real difference down the road. And if you found this episode helpful, please subscribe to the podcast and share it with someone who may be considering selling or buying a business. Until next time, I'm Shaun Thornton, helping create happy buyers and happy sellers. Cheerio.